Good afternoon. I am so happy to introduce our guest, Doug Mellinger.
Thank you.
He has graciously agreed to give us an inside scoop as to what is happening with private credit, which is a hot topic. And he had given such an excellent overview during our time here at Uncorrelated PR, and now he's willing to continue the conversation. And as we know, private credit is technically in turmoil. And for our viewers and for those who are relatively new to the private credit market, can you just walk us through as to what private credit is experiencing right now? Why is it this influx is happening? And where you are positioned at Clarion, and what is it that you are doing to take steps to mitigate the risks that are happening in the market? So that was a mouthful.
Yeah.
But happy for you to give a little bit of background about yourself and what the state of affairs are at Clarion.
Yeah, so I'm a partner at Clarion. Clarion is a 26-year-old firm that's focused on both private equity, focused in lower middle market private equity, and in credit.
Yes.
And in the specific area that we have focused on in credit is in what's called the broadly syndicated loan market.
Yes.
So we do corporate credit. You know, when people use the word credit,
Yes.
it's a very, very broad term.
That's why it's great to have this conversation, because you can help narrow the field and the scope down for our audience to understand from your perspective.
Yeah.
So we're talking about corporate.
Yeah, so we're focused on corporate. We're not focused on real estate or art or litigation finance or any of these other areas.
Okay.
Within corporate credit, there is different types of corporate credit.
Right.
There is what most people think of when they hear about private credit. It's referring to middle market companies and
Yes.
lower middle market companies.
Great.
So companies generally with a couple of million of EBITDA up to a couple of $100 million of EBITDA.
Wow. Okay.
That would be the middle market and the lower
middle market. Okay.
The part that we're focused on is what's called the broadly syndicated loan market,
Okay.
which would refer to very, very large corporations in one of two buckets.
Okay.
Either when you read in the paper about KKR
Yes.
or TPG buying a $5 billion company or a $10 billion or a $50 billion company,
Yes.
and they need to raise $1 billion, $2 billion, $10 billion of first lien senior secured debt, so the very top of the capital structure, that's the kind of debt that we're exposed to. Or it could be non-investment grade public companies.
Okay.
Could be somebody like Chipotle or American Airlines or Dell Computer.
Okay.
When they need to raise first lien senior secured corporate debt, that's the kind of debt that we're going to be exposed to.
Okay.
Now, when you talk about the credit market in turmoil,
Yes.
there is real significant issues right now.
Okay.
In my opinion, somewhat of the industry's making.
Okay. Can you expand
So,
on that
yeah.
thought?
So if you think about middle market and lower middle market, direct lending, private credit, that's the various words people will use to describe those kind of loans.
Yes.
Those loans are all SOFR plus.
Okay.
So whatever the base rate of SOFR, which
Yeah.
is impacted by what the Federal Reserve does,
Indeed.
plus a risk coupon. So you might have SOFR plus 5 or 6 or 7%. And so that's what those loans are.
Okay.
So when the Federal Reserve is raising interest rates, those funds are going to make more money.
Right.
When the Fed is lowering interest rates, they're going to make less money.
Correct.
So we've been in a cycle in the last 18 months of the Federal Reserve starting to bring interest rates down. And so it's just natural that they're going to have some amount of lowering
Loss.
of their overall returns. The second thing is that there is no liquidity even though the word market is in
Yes.
middle market, lower middle market, there is no market. So if one of the lenders decides to wake up tomorrow and they don't like that company that
Right.
they've lent to or that sector, they can't go sell it. There is no market.
Right.
So they're stuck with whatever's going to happen to those companies.
Right.
It's also, there's no transparency. So the market, I can't go to a database and say, this company that Clarion bought
Right.
in its private equity business, who's the lender? I don't know.
It's not public information.
There's no S&P and Moody's
Right.
ratings.
Yes.
So it's whatever they're going to define as the value of that loan. And then ultimately, at the end of the year, they need to sit down with their auditors and defend what their valuations are going to be.
Right.
But during the year, there's no pricing on each
Okay.
company because they're not traded.
Correct.
So there's no discovery of what price is. So last year, an increasing number of companies were doing one of two things.
Okay.
They were either saying to their lender, you know, we're having some trouble. Rather than us paying you this quarter, we're going to pick. We're going to pay you in kind. And so we're going to delay payments and you'll just add it to the balance,
Right.
in essence.
Right.
Or people went to their lenders and they said, you know, we want to extend the payment terms. We want to change the terms.
Right.
So it's referred to as amending and extending.
Okay.
So rather than calling something a default,
Right.
you just repaper it
Yes.
and just give them another couple of years to be able to work out the problem. So people were not seeing really how difficult the portfolios might be having
Right.
experience because of a lot of these practices. So then two things happened this year.
Okay, tell us.
The first one was in January,
Yes.
companies started to reduce their NAV. And so you started to see this fund say, we're lowering our NAV in January
Right.
based on December 31st marks by 15 or 20%. It was still at par in November.
Right.
Why? Who knows? Because they didn't have to change anything.
True.
And so all of a sudden you have a situation where a number of organizations in the industry start to say, well, the portfolios aren't worth as much. Then February happens and a report comes out that says AI is going to eat software.
Right.
And a lot of these lenders had 20, 25% or more of their portfolio was in SaaS software companies. And they had some of the companies where their exposure was 2%, 3%, 5% of the portfolio was in one company name.
Which is significant.
huge.
Yes.
So people started to get nervous, and many of the companies had created a semi-liquid product. Now,
Okay, that
investors
sounds-
only hear one word: liquid. So the documents say you can put in a request to get your money back,
Right.
but we'll only give back up to 5% of the total portfolio. And many of these firms got the first time out 7, 9,
Yeah.
12% of their investors said, give me my money back.
And that was
So-
unheard of.
Unheard of. So
Yeah.
technically, they only had to give back 5.
Right.
But some of them, in my opinion, made a mistake.
How so?
They raised the cap and said, well, we'll give 7 or 9, and I think one of them gave back 12%.
And why would they do that, Doug?
I have no idea why they did it.
Okay.
But they thought that they could, I think they thought they could stem the tide
Yes.
and
If they appease
tell everybody else, everything's safe. Listen,
yeah, look how I can
these guys
give
wanna
you
go out.
what you want.
But what it said to everybody who didn't ask for their money back was, oh my
my
God,
God.
what's happening? I better get my money out.
So it created a domino effect in a sense.
And that's what the industry is dealing with right now.
So, in your opinion, what do you think is the mitigation to this domino effect that has occurred?
So part of it's going to be time.
Okay.
Because fundamentally, they do have a lot of cushion
Yeah.
because they might have had 50% is debt, but 50% is equity.
So they have 50% of their portfolio that they can still be assured and relying upon. That's not
Well, they have,
technically touched by this.
they could take the keys,
Yes.
okay? And then they could become the equity. They could own the company.
Right.
The problem is that many lenders are not set up to take the key. They're not asset managers.
Right, exactly.
So they're reluctant to do that.
Okay.
But they need to give confidence to their investors
yes.
that the world is not coming to an end.
And you believe the world is not coming to an end?
I don't think the world's coming to an end.
Okay.
I do think that some of the lenders have more trouble than others if they have significant exposure to a smaller number of companies
Yes.
and if they have significant certain sectors like software. Again, software is not going away overnight,
Of course not.
but there's a very substantial and real question on what is the terminal value going to be if you're a seat-based and AI is going
Yes.
to change the dynamics of what seats mean. So there is certain of the companies have more challenge than others.
Okay.
And as an investor, you need to try to get underneath the covers to figure out, is the firm that I've given my money to, the direct lender, are they going to struggle or are they fine?
Exactly.
And not everybody's going to be fine, but not everyone's going to struggle.
Okay.
If we were to go buy an apartment building
Right.
over there, the income would be the rent.
Yes.
The expense would be the mortgage.
Right.
And then you and I, the owner,
Yeah.
would get to keep the difference between the rent minus the mortgage.
Perfect.
In a CLO, the rent is the interest payments from the hundreds of companies
that are in the box.
that are in the box, and the cost would be the AAA to double B mortgage, I like to call it.
Yep.
And so you collect the interest,
Yep.
you pay the fixed payment,
And then the
equity
difference.
keeps the difference.
Amazing.
Now, the name of companies are not fixed. They turn over time. So it's like somebody moving out of an apartment and you rent it to somebody else for either a higher interest, a higher rent, or lower rent, or the same rent. If the rent goes up, income goes up, but the mortgage doesn't change. That's fixed. So you, the owner, make more money. And it works just the opposite. So what ends up happening is, for us,
Yes.
in volatile times, like today,
Yeah.
as the name of companies turn over, the replacement loans pay a higher interest. So we actually like volatility.
Right.
So we're the direct lenders, the middle market, lower middle market, they don't like volatility.
Right.
Because if they get a default, a company go bankrupt,
That's
they're
it.
going to lose the money. For us, volatility leads to us actually making more money.
And just to finalize some thoughts here, I'd love to get your opinion. How long do you think this cycle of volatility is going to continue? Obviously, you want it to continue, but from a strict, market perspective and based on previous market cycles, where do you think we are in the cycle, and where do you think this cycle, at what point will it end?
So, there's a lot going on right
There's so much.
now. You have geopolitical.
Correct.
So what's going on in Iran and the Middle East,
Yes.
in Russia, the Ukraine,
Yes.
the China question of what's going
Always-
to happen when Trump and President Xi get together. So lots of geopolitical risks
And
and
uncertainty.
uncertainty.
Yes.
And I think uncertainty has been the word of the last year.
Yes.
So that's one element.
Okay.
The second element is just the economy. You know, are we going to go into a recession? Are we in a recession? Is the Fed going to lower rates, keep them the same, or raise them? Like, there's a lot of uncertainty on what's happening in the economy. Generally, people think things are going pretty well. So this is long-term.
Yes.
I think we're in a positive long-term trend, but I think we're in a bumpy phase.
Okay.
And then you layer on all of this technology.
And then you have AI.
You have AI, we've got...
What's
you
the
know,
future of these software companies?
SaaS is a huge question. But as you look over the next several years,
Yes.
we've got quantum coming down
Yes.
the track. We've got blockchain and tokenization.
Indeed.
We've got robotics.
Robotics.
I mean, it is so much stuff happening, and in our history of the world, we have gone completely hyperbolic.
Indeed.
We've always had technology change, but things that used to take years or decades is now happening in months.
Maybe even minutes.
Yeah, I mean, all of a sudden Claude Code comes out in
know,
November, and it's changed everything.
It's changed the cycle of workflow, cycle of investment strategy, the markets themselves. So, again,
So I think
what do you think?
I think that we're going to have at least a couple months to 6 months of volatility related to
Sure.
what's happening, because even after things stop
Yes.
in Iran, you're still going to have months to get the supply chain and the energy
Rectified.
markets and everything else rectified. So it's not going to happen overnight. I think there's a high probability that the Fed continues to pause and just waits to see what's going to happen. So
Sure.
we're not going to get the benefit of lowering capital costs. Technology is ultimately going to be a net positive, but it's going to be very bumpy.
Sure.
Because there's a lot of worry and there's a lot of execution risk in this. So I think the general trend is positive. In the credit markets, one of the other overhangs has been we've had a lessening of M&A. So private
Yes.
equity firms have gone from around a little over 4 years average hold period
Yes.
to right now over 6 years.
Yes.
In the last three plus years, we've added like 2 years to the average hold period. So this is creating problems for limited partners
Yes.
who are not getting money back.
Yeah.
But they've got
They had
capital
a
costs.
specific timeline that they were estimating that they would get their return and that they would get their capital back at the very least.
Because cost of capital has been higher,
Correct.
there hasn't been as much dividend recaps either. So there's just, right now, I think everybody believes, and if you talk to investment bankers,
Okay.
for the last 3.5 years, I've heard from investment bankers that next quarter is going to be huge. But it hasn't happened yet. Everything is there to happen, but it just hasn't.
Thank you so much for your time. I hope we can continue this conversation.
Let's do it.
And for all my viewers and the audience, thank you for listening. And if you have any questions or concerns about private credit, feel free to reach out to info@silverreg.com, and we'll be sure to connect you with Doug. He clearly is an expert in this space, and we look forward to having him on again. Thank you.